going, guys? Wanted to jump back on here, do our monthly market update. Already the end of August, absolutely crazy. The year's absolutely flown by. It feels like we just got started with 2022 and already everybody's back in school. Summer vacation's over. We're headed into wintertime soon. Halloween coming up. I mean, oh my goodness, all of a sudden the year's going to just be over. We're into 2023 already. So pretty crazy. But a lot of new exciting things happening at Sierra Ridge, one of which we got a new office location. So opened up an office here in Roseville, California, which is fantastic for me. I was having to drive from Auburn to Sacramento, which is about an hour both ways. So I wasn't super loving that, but luckily when all the work from home during COVID stuff happened, I wasn't obviously driving as much. But now I just got the Roseville office location actually moved in last week, brought the horse trailer out, got everything loaded up. Everything moved into the new office. So we're up and running. This is actually my first week working in the new location, which again is great for me. I don't have to drive as far, and hopefully great for you guys too. Some of you who may be located around the Roseville area now, we no longer have to go all the way to Sacramento. We can meet here in the new location. So I'll be spending all my working time here now, which has been absolutely fantastic. Loving it over here. So want to go a couple different directions today. Number one, obviously talk about what's going on with the market. I'm sure if you've been paying attention, you've seen all the news about the Federal Reserve Conference in Jackson Hole, Wyoming, the student loan forgiveness programs, all of which, have created a little bit of a negative outlook, which obviously you can already see on my screen here, which we're going to talk about. Then I also want to dive into a little bit of the behavioral aspect of financial planning as well. So let's start with what's been going on within the market. Last 10 days have been absolutely brutal. As you can see here, Dow Jones Industrial Averages down a little over 7%, S&P down about 7.5%, and the NASDAQ down about 9% almost here, just in the last 10 days. So markets have been getting kind of slaughtered here lately. If we look over the last quarter to date, things are still a little bit up. Now, remember, we were kind of having that nice rally throughout this quarter. And not all of those gains have been absolutely eaten away. So actually over this last quarter to date, NASDAQ's up almost 7%, S&P's still up 4.5%, and Dow's up 2.5%. So these losses that we're seeing right now haven't eaten at all of those gains. But when we look at year to date, things are still pretty gloomy here. NASDAQ being down about 25%, S&P down 17%, Dow Jones down 13%. So overall, again, year to date, still pretty gloomy outlook on everything. Again, a lot of which just happened recently, again, with what the Fed was saying. So I want to look into that really quick and show a little bit of quotes that I really liked from what Jerome Powell said at the Jackson Hole conference really quick. So first thing that really stuck out, he said, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. So basically he's saying, hey, we need to just take this in the chest right now. We don't want to keep putting it off and letting the market continue to roar higher, even though that's what, as investors, we wish the market would just continually rise in a linear fashion in perpetuity, just forever. I mean, that'd make all of our lives easy, right? But he's accepting the fact, hey, we have an issue right now, and it's either we take advantage or we're going to have to deal with this now or deal with it later. And it could just get a bigger and bigger problem if we don't extinguish this fire right now. So yeah, we're going to see some slower growth when we raise rates. We're going to have softer labor market conditions. There's probably not going to be as many jobs going on. Unemployment numbers might increase. It's actually going to bring pain to households, to the consumers, to all of us. We're going to feel it a little bit. But, that's an unfortunate thing, but we do not want to have a huge recessionary issue, a huge market downturn, something more astronomical, 2 to 3 years down the road. We would much rather nip this thing in the bud right now, not have to worry about it later on, and just take this short-term pain, even though it does stink. Nobody likes it. Again, nobody likes to see their account down at the end of the year, but, it's all, relatively small compared to what could happen if we don't tackle this instance or this problem right now. So another quote that he said was, longer-term inflation expectations appear to remain well anchored, but that is not grounds for complacency, with inflation having run well above our goal for some time. So yeah, maybe investors feel like, hey, long-term inflation, we know it's going to be around 2 to 3%. It's not that big of an issue, but that doesn't mean that we can just sit back and let our foot off the metaphorical brake pedal, like we've been talking about. The Fed continually just pumping on the brakes. They're trying to slow things down. Over the short term, over the last couple of years, inflation numbers have been well above that 2 to 3% goal. So again, they're saying, hey, we need to take advantage of this and do things right now to avoid a major problem down the road. So after he was saying a lot of those things, again, that's how we see this 10-day horrible downturn in the market. Good news is, I've talked to a lot of you, if you're a client, about this new sell discipline that we've been putting in. Again, something that I think is very, very great. And that actually came into effect and really worked fantastic, just like it should have. So what we've been doing is on some positions that we're buying, setting basically a metaphorical floor below them. So say you buy something at $10, let's say, maybe you set the floor at $5. So once that security falls to the $5 threshold or below, it automatically triggers a sell. Now, what that does is it protects us on the downside, right? If we lose that much, that something that we're willing to lose, and it triggers that sell, we're not going to lose anything below that. But as the price of a security also rises, that floor rises up with it. So it also locks in gains at the same time. And that discipline has been put in, again, just because of the volatility of the market. It's something that we'll always do going forward, but it's especially important right now when things are moving so quickly. So, and it's based off different valuations of different holdings that we have. Now, those valuations, some of them triggered sells about a couple weeks ago now, a few days before the Fed conference happened. So we were sitting at a little bit more cash than normal. We deployed a lot of cash. We got back down to our normal 3 to 5%. Now, as those sell orders happen, we locked in a lot of gains. Actually, we're back up to about that 15 to 20% cash range, depending on the risk tolerance of the account, which the timing actually worked out to be perfect. The Fed came out, said all these things, talked about how they're going to continue slowing the economy, fighting inflation, all this stuff that we're hearing and we're talking about in the market dumped. So again, we're not trying to time any of these things. I always talk to you guys about timing the market, not timing the market. You're never going to win by timing these little events. And that wasn't the point of it. The point of the sell discipline is, again, to protect us on the downside and help us to lock in gains. And it did exactly that. So we have a couple options going forward. Number one, looking at some valuations of different securities that we think might be a good buying opportunity right now. We may be buying back into some more short-term individual stock positions, or redeploy that cash into the more core part of the model with the more solid ETFs and mutual funds, the larger portion of the holdings that, again, if you're a client, you're aware of how those models work. But nothing's going to happen fast. We're not going to be sitting in that much cash for the long run, but we've got a little bit of buying power right now on the sidelines and just looking at some different opportunities that we can take advantage of. So that's where everything's at. Again, nothing major changes wise with any of the models. Most exciting thing is the new Roseville office, which is a great thing. So that's everything market wise. Now, I also want to talk a little bit about, again, the behavioral aspect of financial planning. And there was something that happened this last month that really made me start thinking about this. I actually just did a podcast about it as well. But our dog, Ruff, passed away. He was a border collie, absolutely amazing animal. Believe me, I'm telling you, I'm not lying about this. He was about 22 years old, and I'm being conservative on that number. He might have been more like 24. He was really old. And I don't, some of you are going to say, yeah, no chance, Hunter. I know you're lying. I'm not lying. I'm telling you. And I really thought this dog was just going to live to be 35 years old. It's every single year we were saying, man, Ruff is not going to live through another winter. And he did. And he did. And he kept going. He just would never give it up. And he was just an awesome animal. Unfortunately, passed away in his sleep a few weeks ago. So at least he went out on his own terms. He lived a fantastic life. But again, I thought that he was going to be the most famous dog in the world for living the longest out of any dog in history. It just really seemed that way. I thought that, the cats have 9 lives, Ruff had 10. But anyways, he did happen to finally pass away. So it started to make me think, I never thought he was going to pass away, but it finally happened. And at the same thing, there's a lot of goals that I have, that clients have in their financial planning lives that we think that we're never going to get there. Retirement. I'm never going to reach retirement. Maybe that's 30, 40 years away. Or buying a new home. I don't want to buy my new home for 15 years. That seems so far away. Or, sending my kids to college. Whatever your goal may be. Well, moral of the story here is those events are going to reach us whether we like it or not. Again, it's going to be 2023, whether we like it or not. The thing is, are we prepared for it? So it really made a lot of those goals that, again, I have and a lot of my clients have. I try to explain this to them. They're not as far away as you think. Again, even if it's 20 years down the road, we're going to get there. We're going to get to 20 years from now. The question is going to be, did we prepare for it, or are we going to get there and say, oh, crap, I should have done XYZ. I should have been investing. I should have been budgeting better. I should have been doing all these things, because it's not if it happens, it's just when we get there. The point of financial planning and the reason that we invest and the reason that we build up all these accounts and put them in the right tax type of accounts and do all this different planning is not so that you can go to your friends and family and brag about how big your Roth 401k is, or brag about how much money you got in savings and how good of an emergency fund. I mean, you can if you want. Maybe that's your point. But I believe, for most of us, that's probably not the reason that we're doing these things. So it's easy to lose focus on why I'm doing the things that I'm doing today. Again, especially if it's for something 20, 30, 40, 50 years down the road. Why am I putting away a few $1,000s into an account when I'm not going to need it for 40 years? Well, again, we're going to get to that point. Ruff passing away, it kind of just created a sense of urgency for me. And it was more motivating than sad, It just reminded me that the reason that I'm doing these things and the reason that I have my clients do these things and plan the way that we plan and invest in the accounts that we invest in is so that I can and you can live that ideal financial life that you want to in the future. Again, I don't want any of my clients to ever be taken by surprise and say, oh man, I wish I would have thought about this. I wish I would have started planning earlier. I really wish I would have had a better idea of what I wanted my life to look like. That's something that, I'm working really, really hard to make sure that everybody that I work with and I partner with, we have those conversations. We do think about these things and we are prepared for them. Because again, Ralph passed away. It's living proof the day is going to come. The day is going to come when your kids go to college and somebody has to pay for that. The day is going to come when you maybe want to buy a new house or an investment house and, we got to pay for that somehow. The day is going to come when you want to retire. You don't want to work as much and we need some more passive income coming in. All those things are going to get there. We never thought it was going to get to 2023 5 years ago. But here we are, we're rounding the corner already. It's going to be January before we know it. So again, start thinking about these things. If you have any questions, want to chat, talk about your goals and talk about a way to get there, would always love to chat with you and be able to help you out. So with that, guys, hope that you have a great, one more day, the rest of the day of August here, a great September. We'll talk to you next month and take care, everybody.